Hello, I'm Greg Bonnell, and welcome to TD Active Trader Live, brought to you by TD Direct Investing. This is your educational one-stop shop for in-depth market analysis, investment insights, help boost your trading potential. Coming up, new inflation data is out. Investors are combing through the numbers for clues on what it could mean for the Fed and the path ahead. Plus, Bitcoin, it's retreated from recent record highs. Market watchers are eyeing ETF flows, key support levels, and fresh momentum out of Washington's Crypto Week. We're going to take a deeper dive in today's technical take. And we slice into the bull versus bear debate on Domino's. Can the stock keep delivering, or is it losing its flavor? That's all ahead. You're watching TD Active Trader Live. Let's check in on the markets. While tariffs have dominated the headlines in recent days, the markets have been seeing through it. The S&P 500 modestly higher because now we have embarked on another earnings season. The big Wall Street banks usually kicks things off for us. So let's see what the heat map is telling us in terms of what is putting points on the table for the S&P 500. Right now, it's some of the tech names. We'll get deeper into NVIDIA in a moment, but also looking at some of the financials names. And it's a mixed picture as some of the Wall Street heavyweights start to report their earnings. Want to check out JP Morgan. It's not showing us much. It beat analysts' second quarter estimates, better than expected revenue from fixed income trading and investment banking. CEO Jamie Dimon does say the U.S. economy remained resilient, but the risks remain. Are we starting to see it? Maybe we're starting to see it in the inflation. We'll talk about that. Wells Fargo, one of the rivals, also reporting that's actually down a couple of percent. So an interesting start to the Q2 earnings report barrage, which is going to be coming our way. Let's check in on NVIDIA, though. It is clearly one that is putting points on the table today. They say they're going to be able to resume selling their H20 AI chip to China. They say that's coming soon, that the U.S. government has actually assured them that they will get the licenses they need. These are the higher-end processors, of course. Earlier this year, there were curbs placed on them in terms of exporting them to China. NVIDIA had warned us at the time that could cost them billions in sales. So if that little headwind, speed bump gets out of their way, it's probably going to be good for them. You can see it reflected in the stock action today. And that's your market update. Joining us now for a more technical take on what is happening out there in the markets, Hiran Amin and Jason Natick from our TD Direct Investing educational team. Gentlemen, welcome back.
It's great to be back again, Greg.
Let's dig in. What do we got going on? We got a lot going on.
Yeah.
What are you keeping your eyes on here?
Banks,
maybe?
Banks, yeah. It's the flavor of du jour. So that's what we're going to look at. So I've got, we're going to look at the KBW NASDAQ Bank Index. So the ticker symbol is BKX on the chart that we have here. So this is just an index that really serves as the benchmark to gauge the performance of the leading banking institutions and publicly traded assets in the United States. It includes 24 of the major banking stocks that we have. And one of the things, as you mentioned, Greg, was Q2 earnings season officially kicks off once we have these the big banks rolling out today. Of course, JP Morgan, Wells Fargo, and Citi also are coming out with their earnings. We've got Goldman Sachs, Morgan Stanley still on tap to come out. So that'll be coming out tomorrow. But what we've been seeing is very reminiscent of what's been happening with the broader index in terms of kind of with the financial sector going in this sort of ascending channel, sort of from the start of this year or late last year and continuing on with that momentum. We did see this classic double top pattern, and this is usually a bearish sign when you start hitting the market tops. And we did see that drawdown, of course, in April. But what was remarkable is after the April lows, the financial sector was very resilient. It rallied over 44% from the April lows. Compare that to the S&P 500, about 30% overall. But what it's also formed coming into this new print is we've seen on a weekly chart is what I have. So these are weekly candles. We saw a bullish pennant pattern. And so what this is, looks like a flag, essentially a pennant flag, and it is a bullish move up. So the way we look for the measured move is we take the base of the flag up to the height of it and then gauge the move here. So it is, we saw this big green candle on the weekly show up. Now we have pulled back from the resistance area at the 145. So that seems to be the barrier. And this extends back to, in fact, going back to 2022. So it has hit this highs from 2022, tested it, peel back off of it. So we know this is resistance. If it can break through, we want to see a retest of that to see if there's another leg up on it. But this is the one to keep an eye on over the next couple of days to see what the rest of the financials hold in terms of their numbers there.
Yeah, interesting chart. I didn't know about that we had reached 2022 levels. Bitcoin has been making new highs recently. You got the price action on that. What's going on?
I do, yeah. So let's bring up Bitcoin, obviously in the news for reasons that it's been hitting highs every day, it seems to look. And something about crypto week. So let's peel that back, of course. I wanted to also just gauge, with all this momentum that's being built behind Bitcoin in terms of its market capitalization, where it stands in the entire crypto space. So what we call Bitcoin dominance, and there's a chart you can actually look at it, but it currently sits at about 64.5%. So what that means is in the entire crypto world, 64% of the market capitalization is, of course, held by Bitcoin being the largest cryptocurrency in the space. Now, we did hit record highs yesterday, briefly topped 123,000. I can't believe I'm saying that number, but it's 123,000. It pulled back and retreated back to settled back at 120,000 or so. But the big news, this is all buoyed on the fact that this is crypto week. And so there's a few pieces of legislation that are being worked through the halls of the Senate and the House. But the big ones, just to keep a note for our viewers, it's the Genius Act, which is all about the stable coins. We know that's already went through the Senate and the House. It's awaiting final signature, but there's another one called the Anti-CBDC Surveillance Act. So that's another one, and the Digital Asset Market Clarity Act. Okay, so these are the three top ones that are going through, and the one that's going to be coming to signage, of course, is the Genius Act. Now, this really shows that Washington has turned on its risk-on appetite for cryptocurrency as lawmakers are really going to be debating this, and hopefully by coming into August, we should see some of these come into motions. You talked about ETF inflows. I just want to talk about that because they had another record on there. Spot ETF inflows hit records, 2.72 billion last week, and it was led by 1.76 billion in the IBIT ETF, which is the iShares one that holds the majority of the AUM over there. On Thursday alone, they had the highest record of inflows at 1.18 billion for 2025 is what they noted.
Seems to suggest that's institutional money, right?
Like at that scale, that's got to be big institutions. Yeah. And we also see a short squeeze effect also happening on the chart. Like we see this big bullish candle. So there was a liquidation. 116 was the bar, the sand in the line kind of space where the resistance. Once it broke through that, we saw the short squeeze take place where it broke past it. The other thing I'm just going to note on the chart as well, I've got the sort of the weekly chart pulled up, but this key line, and I'm just going to zoom out for a second over here. This extends back to 2021. We formed this upper sort of resistance band. It tagged it back in like early 2025. It did it back in 2021. But it's kind of diverged since then. But just recently, it's actually broken above it. It's not even tagged. So this is the first time it's broken above that long trend. And that could be now serving as the base for further momentum going up here. We still see the triple bullish crossover, which is on the this is on the weekly scale, that has remained firmly in the bullish territory. They haven't come down on the shorter side of things. So that's one to keep an eye on. And the measured move right now, probably target is looking between that 130 to 135, which it could still extend to as we're going to price discovery area now.
Interesting stuff. Jay, were you ever like a Kraft dinner plus ketchup guy? I was a Kraft dinner guy, but
never a ketchup guy.
I never put the ketchup on.
No, that's not my thing. Even if
this company would love it if you did the two things, right?
So, yeah, this topic is not quite as sexy as Bitcoin, but
Kraft dinner.
Maybe a little bit appetizing,
but nonetheless, still interesting. You've heard the adage, you buy the rumor, sell the news. Well, there's lots of interesting speculation coming out around Kraft Heinz. So this is a very large consumer staple company. We're all very well familiar with their either yellow noodles, if you will, right? But there's some reports out there. They're interested in looking at spinning off kind of their grocery brand. It's a $20 billion industry for them. So this is not a small deal that they're talking about. This is among speculation. They're trying to turn around some of their delivery on kind of top end items on their balance sheet. Now Kraft Heinz, they merged actually just over a decade ago when I was doing some reading, July 2nd of 2015. So it's kind of almost as we flip the decade. When they combined, they were the third largest food and beverage company in the U.S. and the 20th largest consumer staple company globally. So big news coming out there, and we've got earnings coming up on the 30th for them. So really looking to see what they've got in terms of the spin-off coming forward. But turning to their chart, we can see that it's playing. The top line misses are playing out on their chart. The stock is down almost 30% over the course of almost the year. But as I've got it highlighted here from the chart, when the news came out about the potential spin-off, that's that speculation that's starting to rumble. They were up 2.5%. The price popped topped over both the 21 and the 50-day average. So there's some serious momentum that's building from the buy side. But we've now kind of approached a kind of a significant kind of inflection point around $28. We'll see that that move up has been confirmed with the couple last candles. We'll see if we can get it pushed over that and see if we can if that momentum will continue. But the industry and the market is kind of all waiting with their to hear that where that next step's going to be.
All right, interesting stuff. And the staple of every young college and university student's diet, just a row full of mac and cheese boxes on your shelf.
Ramen.
It got me through. All right, thanks for that, gentlemen. If you at home have a question for our team, here's how you can get in touch with us. Just email tdactivetraderlive@td.com. And for more information about the Active Trader platform, scan that QR code on the bottom right-hand side of your screen. It's going to take you to our TD Active Trader Live website, where you can try out the TD Active Trader platform risk-free. Just open an account. You practice a practice account, click on that Try TD Active Trader button. And when you're ready to switch to a live account, simply export your workspace and start trading for real. You guys are going to make me hungry. It's time now for Trading Debating. We talked about KD. The stock in the spotlight this week is Domino's Pizza, a global fast food chain founded in 1960. Before we get going with our debate, guys, just a reminder to our viewers that the securities and strategies discussed on our show are for educational purposes only, should not be considered investment advice or buy, sell, or hold recommendations. Options trading carries high risk, may not suit all investors. Significant losses are possible, so it is important to assess your own risk tolerance. Make sure you do your own due diligence before engaging in trading. Now let's get back to the stock of the hour, Domino's Pizza. What made you guys pick this one to debate?
Well, they have the largest slice in the pizza industry, Greg. They are the top player in the category what we call quick service, restaurant pizza. But also going back to the days when we were college students or university students, when you got tired of ramen and KD.
You said you had maybe a little bit more money.
Yeah, a little bit more money, and you had to make that dollar stretch. You'd usually turn to pizza, and Domino's was offering those BOGO deals. You get a $5 pizza, a $10 pizza. So you couldn't go wrong with it. So we figured, let's see if it still holds true today.
And I will admit it, when Domino's announced they were bringing out stuffed crust, that caught my interest. But now, I'm worried.
Where else can we put the cheese?
Exactly, to give it all. But I'm just now wondering if they'll be able to make enough dough to maintain their lead in that quick service pizza industry there. So yeah.
Way back in the 90s, my Domino's ordering was so regular that the dude would say, "Hey, it's dude, crispy pepperoni on top guy." I said, "You got that right." Yeah. Make my pepperoni crispy. All right, let's get some time on the clock. We all know we like pizza around here. There's none on the table. What are you going to do? Yep. You each got 2.5 minutes to make your case. Then we're going to get some time to counter. You draw from a hat. As always, Kieran, you got the bull case for Domino's Pizza. Kick things off.
All right. When I think about Domino's, they're really a growth stock with more crunch than their famous hand-tossed crust. And Domino's success stems from a couple of things. Focus on delivery, their experience optimization. They're a trailblazer in technology and their innovation, namely, cheesy stuffed crust, of course. But also remember, they pioneered the 30-minute delivery time or get your pizza free. They were the one that started back in 1993. But that's not what's going to be the only driver of the bullish case. Let's talk about the technology stack first of all. It is a moat for them when you look at it. They're not only just a pizza store, but they're a tech company in disguise, as a fast food company in disguise. So it uses really its technology to create a silky smooth experience from the time you place your order online to getting it actually on your front doorstep. Digital orders account for more than 85% of the global retail sales. They've introduced like an app for online orders back in 2007. Also, one of the best things I love about Domino's is the famous pizza tracker. What do you not love about that? As soon as you put your order in, you know where it is, where it's going to be in the oven, and when it's ready to pick up. So you get it right off, fresh out of the conveyor belt when it comes out of there. But they've also added innovations like, how easy they meet the clients to do those orders. You can order through Alexa, your smartwatch, even your car system. Even this, I was surprised by this. If you have your X profile connected to your Domino's account, you can just do a pizza emoji, and you'll get your order. Get your order queued up there. But they have GPS delivery tracking, AI-powered control as well, so they even know they can track behaviors of consumers when they're doing it. The last thing I'll mention is just on the network delivery, they've partnered up with Uber Eats. We know that partnership, and DoorDash is a new one. So they're building out these aggregators, and they're really honing on that 30-minute delivery. So even if they're late by a minute, in China especially, they've committed to say, they're late by a minute, you get your pizza free, of course. 90% of the orders still arrive on time. Let's go into the charts though. I want to look at the price action because it's telling quite a story. I've got the monthly chart pulled up. What I wanted to look at was just focus on this bullish ascending trend that we started back in 2023. It's been respecting this upper trend over here. We've seen it kind of come into this sort of $450, $500 region. So it is squarely pushing towards this and pushing above that 500. It's almost forming like a cup and handle pattern as well that we're about to see here. I'm just going to go into our daily time frame over here and switch that for a second. So if we go down to our daily, what we can see over here is we've got a telltale double bottom.
I thought you said just for a second because you only have 3 of them.
Yeah, I did.
I
was able to get in there.
All right, what would a bear say about Domino's Pizza? Jason?
Well, the bear would say, now it's undeniable that Domino's is certainly the big slice in the market, but just because they're the world's leader in revenue, $9 billion, and they have the most locations, it doesn't mean that just because they're the most convenient option, they're always going to be the best choice. Now, when I took a deep dive, I looked at this is something called the Pizza Power Report, and Domino's isn't even in the top 10 chains in terms of revenue growth from their pizza sales. So I thought that was interesting. But there's really 2 things that kind of stood out to me that it kind of painted the bearish picture for me. The first one is just costs, right? Their input costs are rising. Now, Domino's does keep tight controls on their supply chain and things like that, and they're not as subject to tariffs as you may think. So they do try to focus on finding domestic sources around the world, but input costs are going up. We're talking wheat, we're talking cheese, and we're not even talking labor. That's a big risk for them that the labor costs are going to go up. So those are things. The cost of the pizza, it might just drive them elsewhere. And the second thing is going to be competition, right? So this is a promotion-heavy business that customers always don't necessarily have loyalty, and it's not just you're not just competing with pizza chains. We're not talking Papa John's and Pizza Hut and whoever else, or just the mom and pop shop on the corner. We've talked DoorDash, we've talked Uber Eats on this program before. These are now big competitors that give consumers the convenience that they're able to then just order wherever they want from any restaurant they want. It doesn't necessarily need to be Domino's. So that's something that's going to be challenging. And Domino's does insist on having in-house delivery options, so it's limiting the choices from those food delivery apps. But let's jump ourselves into the chart here. We can see up what we've got going on here. There was a big gap down from earnings this time last year. So when Domino's reports later next week, we'll be curious to see if we'll have a repeat of business. But that gap, we do talk about gaps being filled in quite often on the program here. But the gap certainly was filled in over the last number of years many times, but it's shown very little pressure to kind of move itself outside of that gap. It's been a pretty well-defined range between 480 and kind of that 430 range. And the times that the stock has kind of bounced outside of the range, what's happened, there's been some pretty definitive patterns here. Like a double tops is one that's easy to spot. I've noticed it here. I see that when we popped over, we hit $500. That's a pretty significant psychological pricing point here, where markets act psychologically, and the momentum's going to follow suit. So we see the double top, and we had the pullback on that momentum. And when we even look at shorter time frames, we're even looking to find more. All right.
More is a nice way to more.
That's not like me to stop on the bell, though.
Yeah.
Good argument,
You got caught
gentlemen.
right in your tracks there.
You guys got 25-year-old Greg fighting with 53-year-old Greg right now about like his pizza preferences from his youth and where he is now. Yeah. What are we going to do? What are we going to counter here? What's the back and
I'm going to
forth?
start by mentioning what Jay said. When you talk about market share, if you look at it, so 20% of the U.S. market share belongs to Domino's, 12% of Pizza Hut, 8% of Papa John's. We won't talk about the rest of them. The rest of it is dominated by the regional players there. But one of the big moats that they also have is the locations. 21,400 is what Domino's has versus 19,000. But why they strategically done this is because of the delivery, how they can connect to these different communities and still be able to sort of, as you said, control their costs. Mm-hmm. So they have the input costs, but they also pride themselves in delivery and getting your order on time there. And having these locations allows them to be sort of agile in that space. But also when you look at a unit metric as a business, if you think about, if I would open up a Domino's franchise, what am I getting in volume? They're the highest volume at 1.4 million average volume, edging out like again Pizza Hut and their biggest, and those are the two competitors, Pizza Hut and Papa John's, and even just returning on a cash by cash basis, cash by cash returns, best one amongst those competitors that they have there.
If you want to talk about locations, though, like it's not all like sunshine and rainbows. Like Domino's sets targets for opening new locations for themselves. Just to pick out one location, because they pride themselves on being a player internationally. Well, they set a goal of having 1,100 franchises opening up this year in France alone. They're not even going to come close to that. They're going to hit maybe 800 if we're lucky.
800 is what the number is.
And then if we think about not just store openings, talk about store closings. There's been over 200 Domino's locations closed over the last year. The Japanese market was the biggest hit with 172. And these are the Japanese market is typically an American culture. You know, they're hungry for this.
You're missing out the biggest growth markets, though. Their expansion into the Middle East is significant. They just partnered with master franchisee out there, Alamar Foods, going into Saudi Arabia, Dubai, and UAE. But even in India, if you think about India, which is a country of, last count, I think it was like just over 1.5 billion population, they have a 70% market share. In China, they have about a significant market share, but again, the delivery, we talk about the delivery and the pace of which they're able to connect to the Chinese markets is significant. When you look at the fundamentals, though, when you peel it back with some of those things, and I'm going to bring up some of those numbers, when you look at their operating margin, it's at 19%. And Pizza Hut stats at 15, Papa John's is at 12. So when you think about, again, costs and efficiencies and them able to control that, those effects are going to be less felt to Domino's than it is going to be felt to Pizza Hut or those other chains.
You know what else isn't growing? Is same-store sales, right? So quarter over quarter, we've got now 4 quarters of declining sales on individual. That might be an oversaturation problem. They had almost 5% growth. We're talking this time last year. Now it's actually declined to 0.5%. So that's been a significant growth factor to look at if we're thinking about from a franchisee perspective. And then we're thinking about overvaluation. This is a company that's focused on expansion. Yes, they focus on tech. But now if we look at from a debt to equity, they have a negative debt to equity of 1.3. It's actually over their 3-year average.
You're going to look at free cash flow yield when you look at that.
Spirited debate, the Belgium. You guys are throwing countries back and forth. I'm like, are they in Italy? So I did a little search. They pulled out of Italy in 2022. They could not make. I was wondering, did the Italians embrace American pizza? And apparently, when it comes to
that would be sacrilege if you did that.
They did not. They did not. Mark Calaminici knows what we're talking about here. All right, in the control room. Awesome debate. I think we know where our passions lie. It's with food. That's one of the most spirited debates we've had in a long time. Now we're going to jump into the platform, talk about how to possibly play these positions through options here, and take it away as the bull.
Yeah, let's talk about the trade we can possibly do. So I've got the chart pulled up. Now, one of the things I noticed with the chart is that if you go back, we've got the weekly chart looking back over here. We can see this key level that's been marked up is like this 450 level where we've seen it being resistance previously, and it's now acting as support. So the trade that a bull could consider, in fact, is if you want to speculate to the upside where you think there's a further upside move up to the 500 level, which marks a resistance point on the weekly chart, you could go long a butterfly call spread is what we're looking at. I've got it mapped out. So exactly what is a butterfly call spread? So essentially what it is, it's we're going to be building out a call. So it's there's 3 parts to it. So we're buying 1 call at the 450 strike. We're selling 2 at the 500, which is where our resistance point is. And then we're buying 1 further out, keeping the distance between the spread exactly the same, which is 50 points in this case, at the 550 level. Now, the reason we do that is we just want to cover because we sold 2 short calls just to cover ourselves in its entirety. Now, the way the trade works is one thing to note, and you know, when Jay and both myself and Jay were researching this, Domino's has only monthly options. It does have liquidity issues in the sense that you don't have a significant amount of volume. Even just looking at today, look at the total volume across all the expiries. You've got like 58 and 14 contracts being traded across the board, right? So that's one thing to keep cautious when you are trading a name like this, to double check the liquidity. But it isn't a point where the IV percentile or implied volatility going into this earnings print coming out next week is fairly low. So there potentially could be 2 catalysts here. One is the potential upside move, but the second is also expansion of the IV leading up to it, which we could benefit from as well. So we're looking to spend about roughly try and get in on this trade about $17 or $18 at that price. And we stand to make, if it goes in our favor, we're going to be making the spread between 50 minus 18. So in this case, $32 as a profit, potential profit there.
If it does not go in your favor?
If it does not go in our favor, here's the worst case scenario, of course. If the stock just remains below 450 coming out of their earnings, then we're going to be in the hole, the debit that we spent over here. The other case of the scenario, if it goes way past it. So the butterfly trade is unique because it's almost like trying to hit a bullseye. We want the stock to kind of stop at the 500 mark coming to expiry. We don't want to start going above it. You start getting diminishing returns above 500, but as it crosses above our long strike at the 550, then we also lose in that point. We're debit because you're in the hole, the full spread on this side. You made it on this side. You're going to fork out the cost. So we don't want to go as far as 550, but we also don't want it to fall below 450 on this trade.
Interesting trade. How could a bear potentially trade this one?
All right, so I want to kind of reiterate the fact around like the monthly options things is something you really want to be zoned in on and make sure you've got good familiarity with the stock that you're trading here. But the big thing here too is like when finding my trade, we had some really wide spreads between the bid and ask, which can make it challenging for the trade. So I was thinking about doing a credit trade, doing like a credit call spread. So you really want to make sure you're getting enough credit out of that. And then if there's liquidity problems, if I do need to, go ahead and buy it back, it can make it challenging to buy it back at a price that's attractive and efficient to get the trade, in and out of the market in a timely manner. But so thinking about, looking at the chart we've got here, I've got the strike prices drawn up on the thing. But during the argument, we were discussing how it's been range bound, and one way we could play this through earnings is to expect that range to continue, and so selling a call spread on top of that range. So in this particular case, I've got it drawn up, selling 510s and buying a 520 as insurance on the top side of things. And if we can have it expire beneath that, and looking at the probability of expiration of the 510s, which is what we want to have expire worthless so we can make max gain, which would be the credit coming in. We've right now, when I was doing the research, it was about a 76% chance of that happening. So the odds are in our favor. Certainly there's no guarantees in the market, but we've lined it up so that we've taken on a little bit of time with them being only, looking at the option chain being only monthlies. We needed to go out through to the August expiration to ensure that we can capture the earnings event in this and hopefully get ourselves a volatility crush coming through earnings, even though volatility is not kind of spiked as high as maybe we would have expected going to earnings. But we still can expect, once the unknown becomes known, that the IV could certainly depreciate, and we could hopefully look to buy ourselves out here. So in this particular case, I've got a $10 wide spread, selling calls at 510 and buying calls out of the money, or a little further out of the money at 520. In this particular case, the midpoint's actually shrunk down to about $1.80 on this point. When I was looking at earlier, it was around $3. So you really want to make sure there's enough meat on the bone, because the next question comes from you is, what's the risk? Yeah. Well, any credit spread, the risk is going to be the width of that spread less the credit you took in. So anything that I take in, 30% is kind of a benchmark that I look for. Every trader is going to need to have their level of comfort, and depending on how much risk they're taking on. But we don't want to make sure we're taking in enough credit so that we're leaving enough. The risk is going to be worth the reward that we're taking on.
Right, interesting potential trades there, gentlemen. Thanks for that, and thanks for laying out the bull and bear cases for Domino's Pizza. Just a reminder to our viewers that the debate was for educational purposes, does not reflect our personal opinions about the stock, although we did confess we eat pizza. Now, before we move on, Jason, you're going to elaborate on non-standard options.
Yeah, we're going to talk non-standard options. This was kind of a just continuing discussion from the Kraft Heinz, not to bring KD back up into the discussion here, but non-standard options. So just to level set, a standard option contract has a deliverable of 100 shares per contract. So if you have the right to buy or right to sell 100 shares at your strike price, but if there are big events, we're talking mergers, we're talking splits, we're talking spin-offs, not regular dividends, but special dividends, those that are fundamentally changing the company itself, the option contracts need to be adjusted to align for that. So I want to show everybody in the system where they can get that information. So let's pop back into the option chain. I've got Kraft Heinz up on the screen. Nothing's been confirmed. So if we look at all of the different expirations, this 100, that is telling me that the multiplier of the contract is 100 shares per contract. But if you're looking to find out if there's something else that's going on, you can go up to the top right-hand corner of the option chain itself, where the filters is put there. It's defaulted to have it off because most option traders are going to be trading standard options. It's easier, it's more efficient, there's more liquidity typically with standard options. But hey, if you happen to have one in your account, or you're looking to open a position on something that's got non-standards, you certainly want to be aware that they're on the chain. So we toggle that on, go ahead and hit apply. I was able to find a couple different ones for names that people might recognize. So if we look at Baba was one, let's bring that up in the chain. I've got to be able to type properly here to make that happen. So noticing, let me go ahead and collapse these expirations. Noticing here next to the 100, there's actually an additional delivery. So Baba would have had a special dividend that was paid. So that would need to be made up and accounted for in the deliverable. So in this particular case, it's 100 shares plus $95 US per contract. All right, there's another one that we want to show up here. There's Nectar Therapeutics, NKTR. they had a reverse split that went through. Noticing here, they've got, what's interesting here is that you've got the 7 next to the 100. This is noting that I think it was a 1 for 15 reverse split. So the number of contracts, or the number of shares per contract is actually reduced in this. And if we take a look at the standards, which actually got released, they would have been released just afterwards, you see the strike prices for the standard options are now using the post-split price. And if I go ahead and minimize it, you can see that the non-standard, which is just 7 shares per contract, is representing the pre-split price. So it's just something to be aware of if you want to avoid the complexity, if you want to avoid the potential confusion. I know from speaking to clients in the past, is if you've bought these without doing your research, there's no free lunch in the market. So it's one of those things you need to. It's really buyer beware. But this is how you can keep on top of that in the platform.
All right, important stuff to know, and I didn't know that, so I learned something. Hopefully the audience learned something too. If you have a question about the TD Active Trader platform, or if there's a stock you want to see our debaters go head-to-head on, send us an email at td.activetraderlive@td.com. And for more information about the Active Trader platform, scan that QR code on the bottom right-hand side of your screen. It's going to take you to our TD Active Trader Live website. So if you can't join us live, which we are at the moment, but if you're watching us later, we're not. Yeah, that's a head scrambler. Can't join us live, be sure to visit our YouTube page where you can catch up on all our previous debates. The link is right there at the top. And if you're going to go there, don't forget to like and subscribe. All right, guys, before we wrap up, what is on the radar for the rest of the week here?
Hey, we've got some impactful data prints that are coming out this week that we got to parse through. I know CPI already got released today, at least, just modestly up. But the important thing about this is you're going to start seeing a little bit of those tariff effects now starting to creep up and show up in some of the macro data here. PPI is going to come out tomorrow. This is the wholesale price changes. That's often a leading indicator for CPI. It's kind of role reversed usually. So CPI came out today and some of those costs getting passed on to CPI. So maybe next month's print will be indicative if PPI ticks up, what that could mean. Now, this is on the backs of the tariffs that have been kicked in. The 50% levy on Brazilian imports, 25% on Japanese and South Korea, I believe. And that could, again, elevate some of these input costs for these producers. And then we also have this week, 30% on Europe was announced, 35% on Mexico, America's largest trading partner, the United States, and of course, 30% on Mexico, 35% on us, on Canada as well. And then retail sales on Thursday is another big one to look at. Consumer spending, where we're still seeing that, how healthy is the consumer spending, and are there any curbs coming in with input costs like typical staples that you have, and what that could mean there. So, but the other one that I have, it's an earnings season. We said we kicked off. So GE Aerospace is the one that I'm going to be squarely looking at. They're going to be reporting earnings before market on July 17th here. Now, ahead of this, they're looking for an adjusted EPS of about $1.43 per share, which represents about a 20% growth from the same quarter a year ago. The great thing about GE, or the management has reaffirmed that this year's full guidance is still, they're keeping firm with it, looking for an EPS of about in that range of 5.10 to 5.45, so 5.28 is what they're looking for. But the big news that's coming out for those folks who might not be aware of GE Aerospace, so this is, they kind of split their business off. This is the division just focused on the aviation side of things. They really supply 60% of the global narrow-body fleet. So those wind turbine engines, of course, you've probably seen those GE branding on them, but they're also big on defense as well. They signed big contracts with the Indian Defense Ministry, so powering some of their fighter jet engines and helicopters as well. India's largest defense contract, in fact, which GE is partnered up with. But the other news as well, in addition to NVIDIA getting some of the restrictions lifted off, GE also got their restrictions lifted off dealing with China again, and Comac, which is China's aviation state producer. So they're going to be able to supply engines out to them. Looking at the chart, Greg, it tells quite a story. I've actually looked at the monthly chart, and I wanted to just see how GE's been tracking. We've got it back to 2011. We've seen this big ascending sort of bullish run that started back in 2009, sort of took a dive at 2017 and stopped. And so this has been, it's tested a few times. But what's remarkable is now we've finally, on a monthly basis, we've broken above that trend again after a drought from 2017 till 2025.
It's a long drought.
So it's a long drought. So
there.
it's back up in positive, resuming this trend here. I've got the daily back, some other momentum squarely on it. So this is that monthly bullish trend that we saw. Here's the break that's continuing on with this momentum. We've seen this new daily support sitting at the 235 level. We've got a cup and handle formation. Again, this is my favorite pattern, bullish pattern, that's going to say where could be the next leg up, because this is an all-time high GE Aerospace has just hit at. Currently what is its price is sitting at. And so we're looking at a measured move potentially in that 280 zone based on this bullish sort of momentum. The other thing with those oscillators, when we look at RSI and MACD, are they kind of singing from the same storybook as the price action is? And then by and large, they are. We've seen RSI kind of hold up the 50 level, kind of duck in and out between that 70 overbought zone, but is remaining squarely firmly in that. So going into this earnings print, we should see if there's some good news coming out of it, which could give it that extra momentum and leg up to push towards the 280 level there.
Interesting ones to watch. I'm not watching a lot of TV in the summer, and I'm not streaming a lot. You got Netflix.
I got Netflix
what are we expecting
here.
on Netflix?
I wager that some people are trying to maybe beat the heat and stay inside and watch
too.
a little TV. So, but the streaming giant Netflix reports on Thursday, and they've got big expectations from the street. Year over year, 40%, looking for a 45% bounce in EPS from 488 in Q2 last year up to over $7, so $7.08 for Q2 this year. Now, we've debated Netflix here in the program a couple months ago. I think we were chatting about, and they're a mature business.
And it's on the YouTube channel if anyone wants to watch that debate.
Absolutely, get in there and take a look. 90 million subscribers in North America. Going to be listening to see what that international growth is looking like. But it's all about content when we're thinking about retaining existing customers, bringing in new customers, and Netflix is spending, or they've got earmarked $18 billion for 2025. One of the interesting things that I've talked about or read about here is that they're still arguing and really firm that the theatrical releases are not part of the long-term model, and they've been really focused on bringing and signing exclusive content deals with big-name content producers. Greta Gerwig from Wonder Woman fame, right? But she's now signed on to do their exclusive contracting with. They've just acquired the rights to Chronicles of Narnia, so I'm really curious to get a look at that. And then Ryan Johnson's on board to do 2 more sequels for the Knives Out franchise. They were a nice watch the first time around. But looking at the chart, Netflix has been on a heck of a run. We can see that. But after hitting highs towards the end of June, early in July, there's been a slight pullback here, 6.5%. Not that 10% correction level, but still something. There's probably some profit taking coming on. But it's one of those things. They've been using the 21-day moving average as kind of like a dynamic support. But as we head into earnings, there's kind of mixed signals on the chart. Both from an RSI, money flow index, they've been taking a bit of a wait and see. And if we take a look at the MACD is actually on a downtrend and has just crossed over. Still firmly in positive territory, but the trend is down. So we're looking at oscillator trends as opposed to pricing trends. So interesting to hear what they've got to say later in the week.
All right, and another interesting show, gentlemen. I really enjoyed it. Sitting here up close. I hope the audience enjoyed it as well, and we'll be back next week.
We'll do it again, Craig.
Do it again. That's our show for this week, though. As always, investors should perform their own due diligence before engaging in trading. Thanks for watching. Where's my pizza?